Let's get started.
Okay, great.
Thanks everybody for taking part in this webinar that Accountfully is presenting with K2 Financing and Keith Kohler, which we'll get a little more introduction here in a minute on that. Just for everybody to be aware, Accountfully is planning on having these webinars around various topics related to accounting, finance, bookkeeping, taxes, etc., moving forward on a monthly basis, and we'll keep you guys all aware of kind of those opportunities and those topics. And if anybody has any interest or any specific things that they'd love to discuss, we're happy to advise. Our goal here at Accountfully is to really help kind of provide a lot of information and data to our clients to help them, make good decisions for their business and take it wherever they lead. And I think that this webinar here specifically is titled Debt Financing Strategies to Grow Your Business and then obviously keep more of it. I think it really hits a lot of our current clientele's interest because in the space that we're in with our clients, many of our clients are in the space of already either like, how do I bring more money into my company, whether it's friends and family or whether it's debt, including credit cards, cash flow loans, merchant loans like Amex, PayPal loans that you see today, as well as, how do I get down to that? The bank, how do I become bankable, get a bank loan or an SBA loan, etc. And Keith Kohler from K2 Financing is going to really kind of advise on that today in this meeting. And if anybody has any questions or comments along the way, please type in the chat box and all that type of stuff. And we're happy to, I'll stop and kind of answer that questions live or raise your hand as well. So without further ado, I'm going to hand over to Keith Kohler here. And Keith, can you give a little bit of background to who you are, what K2 Financing does, and all that type of stuff so that the attendees can get a good idea of that?
Absolutely. Thank you, Brad, and I'm very glad to be with all of you today. My name is Keith Kohler. Again, my company is K2 Financing, and I've worked with a number of companies across various industries and throughout the United States on helping principally with debt financing strategies, but overall holistic financing strategies about how to grow your business and how to optimize it and provide all the rocket fuel you need to move forward and accomplish all your business and your personal objectives. And so we can just go right in, Brad, with the first slide. So why we're here today, and really my commitment and my promise to all my clients is exactly this, what's written here, and you can read it. And the key thing that we're going to be doing today is looking at particularly the highlighted or the underlined items and diving in and getting more information and perspective on what each one of those means: right money, right time, and best terms. And what I'm also going to share with you is the type of typical process that I put my clients through and that we work on together successfully in order to understand what we're going to do, what product for all objectives. So let's keep going. Okay, so on the financing strategy for all of you, you're going to have these three component parts at one time or another, or at least you're going to be talking about them and thinking about them. And in my years of experience, these are the building blocks. So there's financing that comes from you and or sources that you yourself source. There's debt, which is of course today's focus and the main reason that we're here today. And there's equity. So almost all of you, like I said, will have some components of all of these, some greater than others, some less than others. But again, my goal for you here is, particularly with debt financing, is to get you into what you deserve and what you need safely and effectively and efficiently as part of the overall mix, so as to help you keep most of your company going forward and to ensure that you're never caught in a spot where you have to rely on either yourself or emergency equity in order to make it through. Okay, so I advise my clients on all of these different strategies and work on deal structures and terms, but I focus mainly on the debt placement, origination, and getting the deals done. Okay, next. So what do I mean by the right money at the right time? And here's where it is right now, okay? This is a chart which helps summarize all the different types of debt financing that I've worked on through the years and that all of you may want to consider at different times based upon where you are on stage of business and where you are in relationship to your profit, either right now or within, say, the next 1 to 2 years. So this is a chart that we'll go through in greater detail later because I'll talk more about terms and deal structure and interest rates and all the different other things that you might consider when you look at a term sheet. So this is the comprehensive chart that you can refer to again and again and again. And like I said, we'll come back to it later. It's the next one.
Awesome.
Okay, so the process really begins with starting where you are. Of course, that's pretty obvious, but starting where you are for our process and determining what's the right debt financing strategy for you starts with this list. And I'm dividing it for you into two columns. Essentially, I need to take a look at everything related to your business and the core documents there, and also on the personal side. So just a few comments on this list, and we'll just go through it one by one together. So first of all, again, we're looking at tax returns. Tax returns really are almost everything. It's the starting point. And particularly in term loan lending, lines of credit, whether bank or SBA, we're looking at last 3 years of tax returns. But all lenders are almost always going to ask for those same documents as well. We're looking for your interim P&L and balance sheet. For our purposes, whenever we're talking to a lender or a funder, we want that P&L and balance sheet to be dated within the last 90 days. So whatever your most recent one that Accountfully has done for you or that you've done on your own, that's what we want to take a look at. Now, last 12-month statements is really talking about your business banking statements. If you have multiple accounts, whether it's business savings, money market, checking, we'd want to see all of those. And then also on aging accounts receivable and aging accounts payable, again, that's an output you're typically taking a look at. We want to make sure we're seeing the columns of 30, 60, and 90 days of aging. Get an idea of how your cash flow happens, how your receivables and payables are managed, and that'll give us a good overview of that. And the last one here is always the most difficult one, but it's always winds up being the most fruitful exercise for all my clients, and I think for you yourself when you go through your projections. You know, we want to look a little bit in the past to see what you've done, to see what you qualified for in the past, but we really want to focus on what's the future hold. And in order to do that, we have to come up with thoughtful projections. And typically what I'm asking you to do is consider doing that through the end of 2021. Because at the end of the day, I want to create for you a 2 to 3 year strategy, which may have a whole bunch of different types of debt products and also you contributing and also possibly equity. But in order to do that, we have to look a little bit in the past and a little bit into the future. So that's the business column. On the personal side, you're seeing the same tax returns for 16, 17, and 18. For all of you there, depending upon your ownership structure and your capitalization table of your business, personal really refers to you yourself and also anyone that has over 20% ownership stake in your company. Sometimes if it's 15, if it's close, or more importantly, if that additional person has a very, very critical operating role in your company, even if they have something below 20%, they could be asked to be a guarantor, either on a full basis or on a limited basis. So we have to look at their tax returns as well. The self-pull of the credit score, we'll get back into that in a moment, but if you're using things like MyFICO or Credit Karma or Credit Sesame, that's something we want to take a look at. And it's not just the score, we want to dive into the history and in particular the recent history. I'll come back to that. The personal financial statement, usually what I ask you to take a look at is SBA Form 413. Again, that's SBA Form 413, which is a very standard form, not just using SBA lending, but all banks are happy to take that as something they would look at preliminarily before they would put it on their own form. And then last 12-month statements here, that's a catch-all for a whole variety of statements, and that can include your personal checking, your personal saving, but also things like your brokerage and investment funds, anything that you receive on a monthly basis that talks about your personal wealth, okay? So again, this is the full list, and this is what we typically want to look at over time. Next one. But for our analysis, I've highlighted here kind of what I would call a stage one analysis. We want to really focus on these particular documents first. And the reason is because these alone will tell the story of whether we can do a deal right now, or if it's something we need to wait for, or if it's something we need to get and work and do some fixes on, or make sure we have some very thorough explanations as to why things are the way they are. So again, just a few additional insights on these highlighted items. On tax returns, you know, we often take a look at just page one of our tax return, but there is a bit more that we want to take a look at, including Schedule M1, and in fact, we'd want to examine all the schedules. The key thing for your most recent tax return is it better than prior years? Is it showing increasing revenue or increasing profitability? Because that's something underwriters and funders pay a lot of attention to. On your interims, we're taking a look at them, we look at them on their own for the time period they cover, but we also annualize them. So if you're showing me, for example, P&L through September 30th, we want to see what that also would look like on an annual basis to see if you debt service or have the affordability to be able to do a loan. On the balance sheet, what I'm focusing on is your cash position and your liquidity. I'm taking a look again at your receivables and your payables. I'm taking a look at your assets, which typically include your inventory and your equipment, because oftentimes that will be the collateral that would be provided for loans, again, term loans and lines of credit. And then I'm also looking just overall, what's the overall health of the company, and particularly the equity that you have in the business over time. Again, I talked about projections. Just a few words on that. If that's something that you don't feel comfortable doing, I strongly encourage you, again, if you're an Accountfully client, to be engaging with Brad and his team. This is a critical exercise that really needs to be done right. No one has a crystal ball. No one can tell perfectly what the future holds. But what I can tell you is we're going to pay a lot of attention to that, because we want those projections to be realistic. We want them to be detailed and have breakouts on your assumptions. We want them to be able to be portrayed month by month. I don't want to see just your summaries. I want to know how your company is evolving over the next 24 months. And again, the types of breakout tabs that I'm interested in seeing are: how do you break out your revenue? What are your channels of trade? What's your cost of goods sold by SKU? And the key expense items. And normally that's things like SG&A or other large numbered expenses that form a component part, the larger picture of your overall financial health and where you're going. Okay, that's the business side. And by the way, that's not just the business itself, that's the borrower. If you yourself as an owner have affiliate businesses, okay, and affiliate business means any business you have more than 20% ownership of, we'll need to take a look at these same things, except for the projections. So we need to see the tax returns and the interims. Things you might have additional companies in would be sometimes some of you might own your real estate associated with your business, or you might have personal investment properties or things like that, or you might have invested in a friend's business. All of that kind of figures into what's defined as affiliate, and we'll look at that as well. That's the business side. On the personal side, again, we're taking a look at your tax return, and that becomes part of what we call a global cash flow calculation. And normally what I'm looking for there is, can you afford to live your life? If you're reporting income of, say, $100,000, but your commitments are higher than that, well, that could be an issue, and that can take away from our global debt service coverage. So that's something as a highlight that we're taking a look at. Self-pull of the credit score. If you are using MyFICO, Credit Karma, Credit Sesame, or anything else that's giving you both a credit score and the important detail about all the different elements that make up that score and your credit history, that's something we want to look at. Most importantly, we're focusing typically on the last 12 months. The last 12 months really need to be as clean as possible, meaning no late payments, no major issues. If there are problems, the reason I include this in this upfront stage 1 analysis is we want to attack that right away. And time heals all wounds. And sometimes a lot of my clients, everything else is awesome. We're ready to go. They can afford the loan. The collateral is great, but the credit needs work, and it just needs time to repair on its own. Most credit issues can be repaired within 1 month. And a lot of times it involves the simplicity of just paying down credit card debt and decreasing the amount of leverage and credit card expenses or credit card financing you have relative to your availability. The last thing, the personal financial statement, that typically takes quite a bit of time to put together. It's challenging because it's terminology that you might not understand and you might be seeing for the first time. And again, if we need to fix some things like liquidity or other issues, it's something we want to jump on right away because it typically takes a bit more time to fix. Okay, let's go to the next one.
And while, thanks Keith so far, and for everybody that's attended here, if you guys have any specific questions in terms of your individual examples, that you feel free to chime in on the chat box. Additionally, at the end of this kind of conversation, I'm going to kind of go through several different scenarios that I know of from Accountfully clients and the history that I have, and kind of broach those with Keith. But if there's anything specific about your scenario or whatever, just feel free to put it in, and then I can chime in and ask Keith along the way. Definitely want this to be a very interactive engagement here if you guys have any specific questions on the slide. So with that being said, I'll move forward. Here we go.
Okay, great. So again, you've just completed step one by going through that process. You assembled the documents, but now what we want to do in addition to the inside side provider, we want to make sure they're accurate and that they're looking their best possible way. And timing really is everything. For a lot of you, you probably might have some seasonal business effects. You might be selling more at certain times of the year and less in others. In Florida, of course, the summer is typically light. So we want to make sure we're presenting at the very right time. If we have to do some fixes, if there's errors, or if we want to make sure that we're optimizing these documents, we want to do that up front. But the one thing I want to focus on here is that the documents that you submit need to be explainable by you. What do I mean by that? We can't ever be in a situation where you're always saying, hey, I don't know, I'm going to need to ask my accountant. That's fine in some circumstances, but when you're having underwriting calls or conversations with lenders, whether it's in an initial period or as you're getting into diligence or more advanced underwriting, you want to have a strong command and be very, very intimate on every single line item that's represented on your financial statements or anything that you submit. Understand what it is, where it came from, what are the component parts, and how it fits into the overall mix of how you conduct your business. And that little warning sign to the right is with the personal financial statement projections and lender docs. Over my years of experience, that's where I tend to find that people have the most struggles, or where they tend to find that they either make errors or they just don't understand how to put it in such a way that it makes the most sense for a lender or an underwriter to understand, and also presenting themselves in the best possible light. Okay, let's go to the next one. So interestingly enough, I told you about a profit and loss statement. And again, whether it's a bank or a lender, that's what they're focused on and what they're asking you to submit as part of their underwriting package. But the step two process for me and what I do is I really want to look at your cash flow. Because at the end of the day, what a cash flow statement does, and by the way, it's not just done once, it's something I want you to be committed to updating and working on. And as assumptions change, as you add new clients, as conditions change, as payment terms change, this really should be a core of what you're doing on a monthly basis. And as conditions change, to make sure you understand exactly where your cash flow sets. And what a cash flow statement does right, leading the arrow down the left, is it really leads to a great understanding of your cash requirements. A good example of the difference between a P&L and a cash flow issue is all of you know, for example, you might recognize revenue from a client when you issue an invoice in 1 month, but you know for sure that you're not going to get paid maybe 60, 90, and in extreme cases, 120, 100 or more days later. So that's a good example of saying, hey, you got the revenue, you're recognizing the revenue on a P&L, you would say you got it on a certain month, but you know you're going to need to handle your expenses and other key items that you're spending money on well before you might get paid. So once you understand your cash requirements, that goes back to fueling the discussion about what's the right mix of the total financing strategy. And again, I'm going to be asking you to think about what you can do, and what we'll be talking about what debt can do, and then we'll also overlay equity. So again, we're looking at all those three component parts of the strategy, but I myself focus on getting the debt, but advise on the other parts. Okay, let's move on. So the next part of once you understand your cash requirements, and you've done that in your projections and your cash flow, at the end of the day, this is what my clients will tell me that are typically they're going to use the funds for. The benefit, of course, is improving cash flow, and you typically get that with things like AR and inventory, financing, PO, and factoring. But the rest of the ones that you see here of use of funds are typically done through term loans, and we'll go back in, I'll go into that a little bit more later. But inventory purchases, again, your raw materials, all the component parts to help you get finished goods. Refinancing expensive debt is probably top of mind for a lot of you, and the more expensive debt can be from almost any source. It's almost term loans and other financing can be eligible to refinance what you've put in, what friends and family have put in. And then a lot of credit card debt is a typical use of funds to refinance that out at lower rates and extended terms. Anything under the sun that's going to be a higher priced. Working capital, for a lot of you, that would be your hiring, you're bringing in new people, you're spending on advertising, you're spending on marketing. Channel spending, depending upon where you sell, if it's wholesale and distribution, or whether it's online, you're going to need money to effectively sell your product and do well in those channels. Asset acquisition may not be for some of you either right now or even down the line, But what I'm referring to there is equipment, whether you manufacture yourself or you're purchasing it for your for where you're placing or getting your product done with your co-manufacturer. And for some of you, it might be real estate. You might be purchasing your own factory or your own office down the line. But also increasingly what I see is often use of funds is paying off early investors. Because a lot of times you get money initially and then sometime down the line conditions change and your initial investors might need that money back. So again, these are the typical use of funds that I see once we have the cash requirement. So let's move on to step 4. And this is getting
one specific question for you. What do you consider expensive debt and what is reasonable debt? Just kind of give the ranges of that.
Okay, sure. So we all know that, again, that the cost of borrowing is still incredibly low relative to historical standards. So when you look at what debt comes in and priced at the best price debt for you, whether it's term loans or lines of credit, you're typically getting numbers in, say, between, on lines of credit, maybe prime plus a spread of 100 basis points, 150 basis points. So something like 5.5% to 6%. If it's term loan lending, you're seeing rates maybe as low as 6% in extreme cases, but as high as 8%. And typically when you're refinancing more expensive debt, that expensive debt is almost always in the teens somewhere. You know, credit cards in the high teens, friends and family loans that came in at 12. If you're getting online loans for working capital from places like Funding Circle or other places, you might see rates in 15 to 20%. And hopefully, if that's not your case, but if you're having merchant cash advances, we know that those are much, much higher than 15 to 20%. So that's what I typically see, Brad.
Good information.
Okay, sure. Okay, so moving on to step 4. Okay, so this is about getting the deal done. And I'm not going to spend a lot of time on this because this is something probably all of you have done in your own sourcing of financing. But what we're going to do again is get the right product mix and sort it out and figure out the timings. We have to make sure we complete all our needed fixes. So whether it's because credit is not right now or the P&L doesn't show as strong as it can right now, it's better to do it later. We'll take a look at all that. When I go to funding sources, I like to bring 2 or 3 to you, so that we can negotiate the best possible deal between them. We make sure the package is complete and looking the best that it can. One thing I'll just mention is, again, going back to the being intimate and understanding your financial statements. When you have that initial interview with the funder, you really want to be well prepared. And that's something I spend a lot of time coaching my clients on so that they know what to say and very importantly, what not to say, so as to make sure we're being very positive and rosy about the outlook for the business. And then the rest of it you see there: term sheet, negotiation, getting more docs, underwriting, approval, and closing. So, how long does it take to get these things done? In receivables and inventory, purchase order, and factoring, those can be much more compressed time frames, usually from 2 weeks to 4 weeks, sometimes longer depending upon us typically and with a funder's availability. For term loan and line of credit products, it can be as fast as 30, and it can be extreme as 90 or 120 days. Okay? Let's go to the next one. So why would you want to do this process now? And really, this is the benefits that routinely good financing brings for people. And more than anything, what my clients tell me is once we've completed a process and get either less expensive financing or additional financing for the company, this is what we tend to get: better cash flow, lower cost of capital, and saving money. You were paying $10,000 a month for the higher expensive financing. Now you're down to $3,000 a month. You can use that additional money for other purposes. It's fueling your growth, and I really want to focus on avoid crises. The reason why I like to do the strategies over a 2 to 3 year period is I never want you to get stuck. And I think we've all been there. When I ran my own businesses, I know I had that. We had cash flow issues from time to time, and you don't want to be stuck so that you have to put in additional money, or your investors, or you have to go out for equity on an emergency basis. Because to get debt financing right, to plan for it, it does take some time. And if we get that in place, more likely than not, you'll be able to anticipate when you'll have cash flow shortfalls and avoid these type of crises. And then finally, I don't want you to miss out on any opportunities. For a lot of you, you're growing your business quickly, you're adding new clients. If you suddenly land Walmart or Costco or some other great accounts, and it's going to take a lot of money for you to get started on free fill and other trade expense, I want to make sure you have that capital ready so you can dive on it right away versus having to say no because the funding's not quite ready for you. Okay, let's move on. And, why right now? right now, here we are, December 10th. We're finishing up the end of the year. And so much of what I talk about and so much what lenders and funders are looking at is right now, they're kind of on vacation. A lot of them are a bit checked out, or they're finished focusing on their year-end priorities. They're closing both a quarter and a full year. So they're more likely than not focused on closing and not originating or starting processes with loans. And then also for you, so as a result of that, they're not starting off processes, but we want you to be prepared for when they are ready to get going again. And that's typically right in the new year. So what can you do right now? We have to get those 2019 year-end financials done. So working with Brad and his team, I can't stress that enough, because if 2019 hopefully is better than 2018, if for any reason it's not, whether in profitability or more importantly, top line revenue, we need to find out the explanations why, and we need to think about how we handle that. If you're profitable or not, sometimes for you, that's a choice. A lot of you might be in and around break even. And if you maybe change some expenses around or delay them, that might result in profitability. Profitability opens up every type of debt financing for you. Lack of profitability takes you away from some. It's typically the term loan and the lines of credit products. So I want you to have as many options open to you if you can, if indeed that's something you can make happen. As an example, if you show an additional $10,000 in profit on your tax return or your year-end financials on an SBA loan, that can result in $60,000 of additional financing available to you. And what wouldn't you do with that type of money? So the exponential effect of focusing on profitability, if you can do it, really is worth it. And the last thing I'll say is you want to be the early bird. A lot of folks in January just don't take a look at their year-end financials. They're focused on other things. But if you get them done quickly, you're going to grab the attention of lenders, and you'll get your deal done a lot faster. Okay, next one.
And one thing I'll touch base on here is regarding planning through the rest of the year. Like obviously from a as Keith mentioned around like showing what your business profitability and P&L shows versus what your tax return shows can be a different situation, because on a P&L on a P&L management report, typically we look at the profit and loss on an accrual basis, whereas from a tax perspective, typically we look at it on a cash basis, depending upon the industry and a lot of different factors. So with that being said, depending upon how we do that and how proactive we are, we can basically adjust that a little bit in order to save you or be, have you in the best position from a tax return plus a kind of a management reporting standpoint. So again, it's all about being proactive and ensuring that we're kind of looking at this, from a good, holistic and long-term, short-term and long-term view for, you guys. All right, there you go, Keith.
Absolutely. So happily, I've put, over the years, a lot of my clients have gone through this process. We've assembled the documents, made the fixes, done the cash requirements, took a look at the types of financing available between you, debt, and equity. And happily, that results in good done deals. And so these are some of my proudest accomplishments, which deals that, were not deals when I first started with them. And happily, I was able to add a lot of value and bring them into the best possible deals. So these are some great companies to work with. And a lot of times, the deal starts one way, but it winds up being quite something different from where you think you're going to start with. And then happily with all of these clients, I'm doing the next step in financing. So Keto Mojo was an SBA loan to refinance merchant cash advances. Now they're having extraordinary growth. We're looking at growth strategies and increased bank lines of credit after years of profitability. On Aura, I advise on all the different parts of the financing strategy. Your founders and what they've put in, their close by friends and family. And we take a look at equity and different equity and convertible note structures there. And I advise them a lot on growth strategies. And as we grow more rapidly in ongoing years, how we would change the mix of debt that we currently have. Suncoast Chiropractic, this is an amazing man, Marine veteran, a very honorable and ethical guy who started up his business. So there is money available for startups in specific industries, and particularly for something like chiropractor. That was the SBA Community Advantage Program, which is a little bit different. It's an SBA product, which I'll talk a little bit more later. 10 Fruits is one of my all-time favorite deals. That's the Tapia family, Guido Sr. and Jr., Maria Elena and Marjorie. Very exciting. The father and mother immigrated from Peru many, many years ago. came and worked on the jobs that they could to get started out. Eventually, with a lot of hard work and diligence, I'm happy to say that was an acquisition loan where Guido was the manager of a company, and he wound up buying the business that he had worked for several years. And now we're in year 3. He's growing, and we're looking to branch into more locations. So these are just some examples of when the process works at its very best.
Yeah, Keith, we have a lot of inventory-based clients that we use and that are on this webinar, but we also have a good handful of digital agencies, professional services, things like that. Do you do you have some examples of how you've helped them in this process?
Yeah. So again, Suncoast Chiropractic, of course, is a service, right? There's no receivables or inventory associated with that. It's all cash and credit card. So in that case, those types of loans that don't have business collateral are almost always based on cash flow only. So whether it's product-oriented or service-oriented, this whole process and finding the debt financing strategy that's optimal still will work for you.
Good.
Okay.
Good to know. All right.
Yeah.
We'll keep moving on.
Yeah, just very quickly, how did I start doing this and how did I get into finance and be very interested in helping people with debt financing? It started out when I was diagnosed celiac, which is gluten-free, back in 2005. I joined an organization in Seattle to work on gluten-free certification of products at plant. And some of you may recognize this symbol. It might even be on some of your products. I was proud to be one of the persons that originated this program as a first business development director. And what I found in speaking to different founders is finance continually was a pain point. It was an area where there was a need for a lot of education and for finding about what would be the right type of financing for them as they were growing the business. That was my real original inspiration, and it's all cascaded from there since. So again, that's how I started out. Let's move on. Okay, so we're back to the right money at the right time. So what we're going to do here is give you some underwriting insights, some deal structure, and some typical terms associated with all the different types of things here. I'll try to move rapidly. This is such a vast topic that almost all of these on their own could be a webinar of their own length. But I want to give you definitely some highlights as we move through. So I'm going to start way to the left in the startup and early stage. Probably none of you are exactly startups, but a lot of you might be early stage, and you might have done some of these types of financing. So on the U side, a lot of you have used your savings, credit cards, life insurance, HELOCs, and we'll come back.
There we go.
Yeah, so we'll just stay on this slide for quite some time. You've used personal loans, you've used IRAs and 401ks. All of that's fine, and a lot of you have done that. The key thing I would just tell you is I don't want you to go all in. Don't use everything that you have available to you, because increasingly in this market, banks are looking at your personal liquidity. So for example, if you had $100,000 to give, don't go all in on $100,000. Make sure that you keep quite a bit of it for your own personal liquidity. And that's going to show up on a personal financial statement. Again, for many of you, you've done friends and family raises. Maybe it came in convertible notes. Maybe it came in loans. We can take a look at all of that, and we want to examine what you've done. But the most important thing that I observe with friends and family loans is what happens when conditions change, or what happens when those investors change their mind about what they want to do. A lot of times you might get someone needing to be paid back a bit sooner, or you want to be able to refinance that out down the line with other types of products, typically term loans. But also importantly for friends and family, you want to make sure it doesn't get in the way of future financing. Okay? And the future financing would be any types of term loan product or equity or anyone down the line. Community development organizations, a lot of times these are local funding options available to you. If you live in a major metropolitan area, there's almost always something like this available. A lot of them are focused on your character, and they're available to earlier stage companies. Oftentimes they have mandates to help particularly minority and women-owned businesses. And they tend to be priced incredibly attractively and oftentimes even below market. An example in Miami that I do a lot of times is a 5-year term loan priced at only 6%. So those are great loans as you're starting out. A lot of times they're based on your character and your business potential. So you don't have to have necessarily profitability, but you have to be strong on selling your promise and how you're going to pay off that loan over time. Okay. Importantly, and this is where, again, where we don't want to get tripped up, is that if community development organizations put a lien on your business, and probably most of you know what that means, you want to make sure that if they can't be paid off, they want to be able to either subordinate or allow for intercreditor agreements for others to come in later to provide you additional financing. Micro lenders, many of those are national footprints, some are local. You may have heard of Acción or others. Again, those are very similar types of small loans, maybe up to $25,000 or $50,000. Again, in the community, what I typically see is the community development organizations are the cheapest in this bucket. They tend to be 5, 6, 7, 8%. Some are on the higher side. Friends and family, I usually see coming in at either convertible note rates of 6 to 8%. If it's straight debt, I often see up to 10, 12% or more. And micro lenders can really be all over the place. Okay. Moving to the next column to tell you a little bit about direct-to-consumer financing. This is an area that just started up a few years ago. For all of you who are selling on the web or selling on Amazon, this is something you should take a look at. And some of the big providers in this space are things like PayPal and Shopify, and even Amazon itself can be a provider of financing for you. You've also seen things that will help you with your management of your receivables and payables, like Clearbank and Divvy and Brex and others. The terms and the way you pay back are very different by whoever that provider is. But specifically PayPal and Shopify and Amazon almost always deduct your payments from what they owe you. And the rates can vary widely all over the place. But usually they come in and say 15 to 20% overall. Again, something that's great if you qualify for it. If you don't qualify for anything else, and as long as you have the gross margin to afford it, then fine. It's something you may consider instead of equity. Okay? So, but again, 15 to 20% is still high relative to what you can achieve further down the line when you're doing SBA or bank funding. For a lot of you, you might want to consider some different funds that can be available for you along the way. There are some private funds out there that I've worked with that typically will lend on AR and inventory and provide capital at much lower rates. There are sometimes family offices that help there. What I typically see there is numbers and say the 8% range on core interest rate or so, but all-in financing, just one step below what you're seeing in the digitally native financing. So almost always say 10 to 12% all in. Okay. Many of you here will have done or probably have experience with either purchase order financing or factoring. Again, some of you might say, wow, that's really expensive. But again, if you have the gross margin to afford it, it's something you should consider because the alternative might be equity, which down the line winds up being more expensive. But the key thing in purchase order and factoring, which you want to know, is it's giving you the funding you need. Well, the PO financing gives you the funding you need to pay your supplier right now. So if you need to get raw materials, if you need to packaging materials, anything to get your product done, once you have a purchase order, you can get advances against that and then help pay for those materials up front. The key consideration on PO financing is your credit worthiness of your customer. So if you're getting a PO from Walmart, that's tremendous. If you're getting a PO from Joe's Natural Product Store, which is a one-off in your neighborhood, that's not quite the credit worthiness that the funders are looking for. The other key consideration is your co-packer. That has to be someone who's credit worthy on their own and who has who's able to fill the order and is very reliable, someone you can count on. Okay. So the typical rates that I see in purchase order financing is an interest rate over a certain period of time. And even though interest rates are low, those rates have stayed relatively similar over the many years I've been doing this. And I usually see a rate of say 1.5% to 2% per 30-day period. Okay. Quick note on factoring. Probably, like I said, a lot of you are familiar with this. And your key benefit against factoring is more predictable cash flow. And how does it quickly work? You're getting an advance on an invoice that you issue. And remember, the factor can choose to factor whomever they want. Going back to that example of Walmart versus Joe's Natural Products, they're going to do that Walmart invoice and factor that, but they probably won't do that one-off little small company for you. When you look at the advances that you get on factoring, it ranges widely based upon your dilution. And dilution for us means if you send an invoice out at 100%, what percentage of that do you get back? Advance rates will depend specifically on that. And I see an incredibly wide range from say 70 to as often as 90%, okay? And so the factor will advance you that money, and once they're done and they've been paid, they'll send you the rest of the money minus their fees. Factoring, again, like PO financing, I typically see a wide range, but that stayed consistent over time. And usually in the pricing is in 30-day increments, as low as say 1.25% per 30-day and as high as 2. Again, depends mainly on the strength of your customers and also the strength of your company at the time. Moving over to break even to profitable. When you move over into this area, and that means essentially if you are break even right now, or if you're approaching break even or going to be profitable sometime soon, now's the time already to have those conversations with these types of lenders, because you're getting a running head start to know how and when you qualify and what the terms you can get in this type of lending. AR, accounts receivable and inventory, asset-based lending is a revolving credit line. It goes up and down with when you issue invoices and when payments are received or collected. So just imagine you're always issuing invoices on day 1, day 15, day 30. You're getting paid on different days. So your balance and your availability goes up and down. The cool thing is it tends to rise as you deserve it. So it's kind of pay as you earn as you go financing. As you grow and you issue more invoices, you're just going to get more availability of funding. Most of these lenders will lend strongly against AR. It tends to be, again, that same wide range of 70 to 85%, depending upon the dilution and the strength of your customer base. Okay. So what are the expected terms on AR and inventory financing? What I'm seeing now is all in, inclusive of core interest rate and fees, usually on extremely aggressive cases, maybe as low as 10 or 11%. On higher cases, maybe 15, 16, 17%. So it's a wide range, and that's where I shop around quite a bit on behalf of my clients. Okay. When you're break even to profitable, and really profitable is what is more important on SBA loans. That again is a vast, vast topic. That's a webinar on its own. But there are a number of programs that you should consider. And Brad, as you're going through your customers and you're talking with everyone on this call and your other customers, if they are going to be profitable this year, only 1 year of profitability is required on a tax return. And a draft tax return is good enough to get the conversation going. So just that 1 year of profitability in order to qualify for some form of SBA lending. There's lots of different products out there. The ones that you would be more familiar with are the 7A, which is typically a 10-year term loan. It's priced at prime plus up to 2 3/4%, which is a wonderful financing at 7.5% with no prepayment penalty. So again, when you think about it, as you're moving through this chart, where you started in the beginning was one level of numbers. The early stage and pre-profitability is one level of deal structure and interest rate and cost of financing. Again, that second column tends to be priced, as you can see, in a much higher level, say from 12% all the way up to 24%. Once you get to profitability, that's when you're going to see, and over to multi-year profitability, that's when your cost of capital is going to come down a lot in that lower 6 to 8% range. I acknowledge that a lot of you may not ever get to profitability, and you might not ever want to. Where if you might be a rocket ship that's growing your top line extremely aggressively through aggressive trade spending or spending online, you may never get to profitability, whether that's your objective or also the objective of your investors, and that's okay. But it still doesn't eliminate you from debt. Even if you're losing money all this time, you still can qualify for a lot of these pre-profitability or even break-even style products, because as long as you have the cash available to you and you're funded, an example would be if your cash requirements in the next year are $1 million and you just got a $3 million check, well, that's still good enough coverage and enough of a cushion to induce a debt financer to help provide you with additional working capital financing. Okay? Key thing I can tell you.
Keep going.
What's that?
I said there's a couple questions, but keep going to wrap up the slide, and then I'll ask those questions.
Okay, yeah, I'll wrap up this slide, and then we'll go into the questions, okay? So again, SBA loans, the key insights there is the SBA is not the lender, the bank is. So I shop around the deals for my clients and talk to several banks, because different banks have different appetites in industry and different specific underwriting criteria, what they're looking for in debt service coverage and collateral and character and all the mix of the documents that we saw up front. The SBA will allow for working capital financing to come in. So if you're getting receivables in inventory or factoring or others, they can work harmoniously as long as everybody gets the lien position on your assets that they're looking for. Okay. So the key things that our SBA are looking for is the ability to repay the loan and also the quality and the size of the collateral. SBA loans can be gotten for higher amounts with short collateral. I work with a number of lenders who are willing to do that, but it's really about the strength of your cash flow, your historical cash flow on your most recently filed tax return, plus the strength of your interims. Okay. Last couple things on SBA, there tend to be some minimum credit score requirements. Remember we talked at the beginning how credit score is a big part of the analysis up front. If your credit score is in the middle 600s, that's something we might want to work on. 650 tends to be a minimum. If you're close and you're borderline, we want to make sure that you strengthen that so that there's no risk of falling below that. Some of the more restrictive lenders are looking for more higher, like 680. We want to make sure that you don't have bankruptcies or short sales or bank losses over time and no open lawsuits. Okay. So again, when you get to multi-year profitability, typically to get commercial lending, term loans, equipment loans, or lines of credit, you need to have at least 2 years of profitability on filed tax returns. Okay. And that's a lot of the same terms, a lot of the same interest rates, where some of you might never get to this and where you might not ever go to bank lending is because of the amount of covenants or conditions that are placed on those types of loans. You might be content to be working with an accounts receivable and inventory provider, which might give you more availability of funding over time and faster versus a bank line of credit, which may give you less availability and be more difficult to grow with you over time. So I know that was a lot of information. Certainly, as you go back through this and maybe listen to the recording again, and I know we have questions here, but additional questions might pop up on this, and you can certainly contact me, and I'll be happy to answer them. So, Brad, you want to go to questions?
Yeah, and I think just for around the line here, like I think this is the biggest, question or information topic to take away from this, because a lot of it really can help you understand the opportunities available at your specific stage of your company, as well as understand the stages that you'll be in the future and kind of how to move up the chain to kind of get to where you want to go. So a couple of quick questions. Number one is, for SBA loans, if you're a U.S.-based company but with a Canada, like a Canadian investor owner, or how does that work? Are you available to get SBA loans with a foreign entity involved?
Depends how big of an investor that person is. If the majority ownership is U.S.-based, then it's able to be done.
Okay, it looks like, okay, that's a good answer there. And then the other question is, so if somebody has a small operating line that they likely can increase, as well as some persistent credit card debt that they'd like to pay down, what are the options out there to replace that with something at a lower interest rate?
Okay, yeah, so it depends on what you would replace it with, depends upon where you are along this chart. And if you are profitable, a typical use of funds of paying down more expensive debt is achieved through a term loan, whether an SBA loan or a bank term loan or a bank line of credit. If you're not profitable, sometimes by getting AR financing or other types of financing in that bucket of early stage and pre-profitability, you can use that additional funding to pay off or pay down credit cards because you have more liquidity and more availability of funds.
Good. Ready to move next slide?
Sure. Okay, so Brad, you want to talk mainly about this on next steps?
Yeah. So basically, as you can kind of see with what the information that Keith has shared here, that there's obviously a lot of information that he shared here. The biggest thing, I think, a couple of takeaways here is essentially, number one is understanding where you're at currently, right? That includes having accurate financials to date, understanding where you're at from a cash flow, and having a good basis of where your business is now. And then step two is having an idea of where your business is going to be in the future, right? Whether that's in 1 year, 2 years, 3 years, whether that's from a cash perspective, depending upon if you're in an inventory-based business, etc. A lot of our clients, when they're raising money, they just think about equity, right? But there is a lot of great debt options out here that can actually help you maintain more of your company from an ownership perspective. Plus, that's more flexible for you. So really, the goal here with this information is really to help you kind of understand and try to be as proactive as possible, with your business and understanding where you're at. So basically, from this, essentially, if for those clients on the line here, there's perspective or people that aren't Accountfully clients currently, and there's people that are Accountfully clients. So if you are an Accountfully client and you'd like to move forward with kind of understanding and kind of getting Keith involved on this aspect to see where your next steps are, or what options are available for you. And that may be, hey, we don't have availability right now. The next 12 months, we need to work on your credit score. Then I think by next year, if you increase profitability and revenue, we can then, in cash flow, we can then, tackle that in 12 months or whatever. So the goal here is not just to say no, it's to say no, but if you do these 10 things, we can get you there. So if you're interested in that, just send me an email, and then we can kind of get Keith involved as well as the kind of account manager on your account to ensure on the same page and to provide you the support information you need. If you're not an Accountfully client and would like to move forward from understanding just pure getting your accounting bookkeeping in order, getting a more accurate financials, be proactive in that matter, as well as then kind of get Keith involved to kind of help you understand where you're going, feel free to drop me a line on my email, Brett@Accountfully, and then we can talk more about that information. So basically, just kind of follow up with me on any next steps with this. And I think the last thing Keith will say is just remember, now is the best time, because right now, with the last 3 weeks, 4 weeks of 2019, we can kind of be proactive in understanding to ensure that your tax return at the end of this year can be, we can kind of make it not fraudulently, but ensuring that we're properly posting information and your financials and your tax return to then set you up for success in the future. Is that right, Keith?
Yeah, absolutely. Mm-hmm.
And then the last thing is your finance strategy will deliver the right money at the right time with the best terms and help you keep more of your business. Again, at Accountfully, our focus is on delivering timely and accurate information to you to make the best decisions for your business. And I think with this information, really the goal is as you, the business owner, understanding that information plus understanding where you see the business from a strategic and long-term view, and then we can mirror like how we can get cash to help support that growth. And it's a lot cheaper to be proactive in this nature versus just pulling down cash flow loans from PayPal or Amex and not realizing because you're in a pinch when we could have been proactive on this 6 months ago. And there's Keith's information if you want to drop a line to him directly. That's fine and welcome too. But again, we're here to kind of help you out as an entity to take you where you're going. So hope you all enjoyed this debt financing webinar. Feel free to email me with any feedback or anything that kind of comes along the way on it. And we'll keep you in the loop on future webinars that we have. Really appreciate everything.